in the heart of summer holidays, and that includes the Fed. They kept rates on hold today, but my guest expects that they will be back in September. Joining me to explain is James Marple from TD Economics. Thanks for being here.
My pleasure.
So no change in terms of interest rates today, James, but that was the expectation. And then the statement was largely unchanged. So what was getting attention?
Well, so yeah, as you said, no change in interest rates. That was, everyone thought that would happen. The Fed hasn't sort of gone out of their quarter by quarter rate hiking cycle, this tightening cycle, so it's been over a decade since that's happened. The statement was largely unchanged, but I think just around the edges, they tweaked up their expectations for economic growth. They changed the word solid to strong, and that really came out because it came out in the first sentence. They said the labor market was strong. They also said household and business spending was strong. They had another characterization of something as strongly. They used the word 5 times, so you really couldn't get around the fact that they really think the economy is growing strongly. And really nothing there that they seem to be worried about in the very near term, at least in the statement.
Now, in terms of that assessment or their assessment of the economy, there are a few things I want to ask you about. The first one is, after the rate announcement, the market's pricing in about an 80% probability that they're going to hike coming in September, and that's where you say, they're coming back from their summer holidays. But you say there are some important data points or pieces that you're trying to figure out where the Fed actually falls in with respect to that. What are you watching going forward?
Well, first of all, obviously the economic data that we've continued to see evidence that the economy is growing at an above trend rate. In the second quarter, it grew by 4.1%. We had some spending data to June, which suggests a pretty strong handoff into the third quarter. So we'll probably get a pretty good growth rate into Q3. The inflation data obviously is very important. We've seen inflation, which has disappointed really for several years, below the Fed's 2% target now look like it's hitting it, and in fact even in their statement they say it's remained near 2%, so that's been a bit of a sea change, not relative to the previous statement but certainly in the recent past. But then I'd probably look at things like financial conditions. We have heard members of the Fed, certainly Federal Reserve presidents, talk about the yield curve as having important information. We saw today actually the 10-year yield push above 3%, so it looks like the yield curve is steepened a little bit, so that is maybe less of a worry today. But if we are seeing signs that there are broader worries in the global economy that comes through in equity prices and in a rally in longer term rates, that may suggest that they ease off. I don't think that would be nearly enough to cause them to not raise rates in September or even again in December. But as we get into 2019, I think things get a little bit more uncertain, and certainly they'll be looking toward things like broader financial conditions and the yield curve as sort of taking some cues from the market about where the economy is going.
One of the things, too, I kind of want to shed some light on is that the U.S. dollar, when you talk about global trends or themes, given some of the trade talks, especially between China and the U.S., that's, impacted the dollar in a big way. Do you think at its current level the dollar is overvalued? Do you think we're at about fair value, and what's your outlook going forward?
Well, certainly it's hard not to notice that the dollar's appreciation has come about just as sort of tariffs and either the threat or the implementation of tariffs have come out. I mean, we see that with respect to the Canadian economy and the Canadian dollar, that some of the weakness of the Canadian dollar, I think, reflects we don't know where NAFTA will end up. We don't know if there will be additional tariffs imposed on autos. The same thing you could say for Europe, and certainly for China, where the talk now is potentially going from 10% tariffs to 25% tariffs. That's something that is pushing up the value of the dollar, and I think if we were to see some signs of resolution, the Bank of Canada Governor Polo said, we can't look at this all as one-sided risk. I mean, at some point we may get resolution, saner heads prevail, fingers crossed. That was something that I think would pull down the dollar a little bit. So if it's above fair value, I think that reflects a lot of the uncertainty with respect to trade with trading partners that, let's face it, have more to lose than perhaps the U.S. does if trade is abrogated.
James, thanks for being here. You've given us a lot to watch going forward, and it sounds like you're expecting September and December for future hikes.
That's right. Thank you.